What if I told you that you can still grow your money even when the market crashes? Whether it is booming or tanking, smart investors make moves that keep their money growing. And today I'm going to show you how. I will break down how to monitor the stock market like a pro, and I will give you real strategies that work in both the bull and bear markets with examples and stories you won't forget. I am Charity Ezenwa-Onuaku, founder of Wealthy Gen, where we turn money stress into money strength. On this channel, I share practical tips and in-depth guides to help you build wealth, grow your business, and live intentionally. Let's get into it. First things first, to make money in any market, you need to understand the relationship between the economy and the stock market, and then be able to identify the kind of market you are in at any given time. The stock market reflects the economic condition of an economy. It reflects two things. One is the level of confidence that investors have in the economy. When investors are feeling confident that the economy is moving in the right direction, the stock market reacts positively. However, if investors feel pessimistic and do not think the economy is headed in the right direction, the market reacts negatively. The second thing that the stock market reflects is the level of economic activities. When the level of economic activities is high, businesses are booming, the government is spending money, and money is in circulation, and people are gainfully employed. When this happens, the stock market reacts positively. However, the reverse is the case. When economic activities are low, the stock market reacts negatively. So what does it mean when you hear the bull market or the bear market? Bull and bear markets are common terms in the stock market, but not everyone understands these terms. Now think of the use of bull and the bear as a metaphor for how the market moves, and take note of how the animals, the bull and the bear, attack their opponents. That is the key. When they attack their opponents, a bull swipes its horns up in the air. When a bear attacks, a bear swipes its paws downwards. So if the trend is up, it's a bull market reflecting a bull swiping up. If the trend is down, it's a bear market reflecting a bear swiping down. A bull market indicates that prices are rising, there is optimism, and people are eager to invest in the stock market. Think of it like the 2020-2021 when tech stocks exploded. People made serious gains in companies like Tesla and Zoom. I had a friend who bought Tesla in early 2020 at around $90, adjusted for stock split. By the end of the year, it had more than quadrupled, and that's a bull market. It rewards bold moves. But then came 2022, inflation fears, rising interest rates, and the market tanked. That's a bear market. Prices drop and people panic. But here's the secret. Bear markets create millionaires if you stay smart. Now you know what the bull and bear markets are. We will discuss the best strategies to take advantage of the bull market and the bear to maximize your earnings. But first, let's talk about how to monitor the stock market. Since the stock market reflects the economic condition of the economy, to successfully invest in the stock market, you should monitor two things. One is events. You are watching and listening for those events that are likely to change investor confidence or affect economic activities. Examples are when there are changes in interest rates. That's an event that affects economic activities. Another example is when economic performance numbers are released, such as job or unemployment levels. And another example is when the government makes policy announcements. Changes in any of these events will likely affect the level of confidence people have in the economy or in the general economic activities. The direction of the effects of these events will guide your investment decisions. Simply listening to financial news such as CNBC will keep you informed about the latest events that can move the market. The second thing you should monitor is the market indices. With market indices, you are gauging the health of the economy using three main indices. One is the S&P 500, which tracks the stocks of the 500 biggest companies in the US. The second one is the Dow Jones Industrial Average, which tracks the stock prices of the top 30 US companies. And the third one is the Nasdaq, which is mostly for technology stocks, and it tracks all the stocks it lists on the exchange. The performance of these indices generally indicates the health of the economy and will be your guide towards making your investment decisions. Now, to monitor the market indices, you can use free tools and apps such as Yahoo Finance, Google Finance. You can also use the Stocks app on your phone for insights and updates. This is Google Finance, and if you look on this page, you will see that we have Dow Jones, we have S&P 500, we have Nasdaq, we also have Russell and VIX, but we are going to focus on the three major indices here for the US market, which is Dow Jones, S&P 500, and Nasdaq. If I tap on Dow Jones, the Dow Jones Industrial Average, which tracks the performance of 30 prominent companies listed on the stock exchange, the average as of today, May 27, is 42,343.65 cents, which is an increase of 1.78%, approximately $740.58 today. Now, it's important to know that Dow Jones Industrial Average is a price-weighted index, meaning that the companies that this index tracks are weighted based on their prices. But S&P 500, which stands for Standard & Poor's 500, and 500 really means the top 500 companies listed on the stock exchange that this index tracks. So S&P 500 average for today was $5,921.54, which is an increase of 2.05% and equivalent to $118.72. Now, unlike Dow Jones, S&P 500 is a capitalization weighted index, meaning that the companies listed on this exchange that this index tracks are all weighted based on their market capitalization instead of the price weighted average that Dow Jones uses. So S&P 500 is capitalization weighted index, while Dow Jones is a price weighted index. If we look at Nasdaq as well, you know that Nasdaq is really tracks mostly technology stocks, and it tracks all the companies that are listed on the exchange. The same thing as S&P 500, Nasdaq is also a capitalization weighted index. Now, as of today, Nasdaq composite was at $19,199.16, which is an increase of 2.47%, equivalent to $461.96. Now, if you look at these three indices, you can see that the market as a whole increased by about 2%. If you average the increase or the performance of these three indices, you can easily tell that the market as a whole saw an increase of about 2% today. And this is how you use these indices to track the performance of the overall market and also the performance of your own stocks or your portfolio. And you can play around in here to see how the different averages or the different indexes perform at different time points during the day. You can see that earlier in the morning around 9:30 at the beginning of the market or at the opening of the market, the index averaged lower at around 18,000, and you can see that it increased and continued to progress, and you saw a little dip and also increase at the end. So you can play around it and scroll down and see what's in the news. You can see what's driving the market. You can see what is trending. You can come here and kind of get informed or be informed about the market and understand how this market really works. If you're interested in tech stocks, you can focus on Nasdaq. It's also important to look at what's happening in the overall. But if you just want to see the top 500 companies in the US, you focus on S&P 500 or Dow Jones if you are really looking at the big 30 companies, depending on what you are looking for. But it's good to have an overall view when you compare the three markets at once. You should set alerts for news and earnings. For instance, if Apple is reporting earnings next week, you want to know, because one good or bad report can move the whole market. And here's my pro tip. Don't just watch the market, learn from it. Create a watch list of about 10 stocks and follow their movement for about 30 days. You will start seeing patterns. Now, let's talk about how to make money in either a bear market or a bull market. And the strategy is simple. Take advantage of the greed and the fear in the market. How do we do this? We do the exact opposite of what most people in the market are doing. In the bear market, people assume that asset prices will continue to fall. So they tend to rush and sell off their stocks at lower prices to avoid further losses. You will take advantage of this fear and buy at lower prices. And to be sure you are not going to lose money, watch and listen for events that are likely to boost investor confidence in the economy. An example can be that the government reports positive job numbers showing a decline in unemployment levels. When this event happens, you buy just at the point price begins to show signs of strength. With this, you are buying at a lower price when prices are beginning to rise, and then you hold this and wait for the bull market. When you buy, invest in defensive stocks that pay dividends. Look at companies that people need no matter what. Can be healthcare companies like Johnson & Johnson, can be consumer goods like Procter & Gamble, and utilities like AT&T. These are bear market heroes. And here's an example. In 2008, while the market crashed, Johnson & Johnson still paid steady dividends and recovered faster than most tech stocks. The next bear market strategy is to use dollar cost averaging. You invest the same amount every single month, no matter what. When prices drop, you buy more stocks with the same amount. It smooths out the price roller coaster you can see, right, in the market. A woman in our Wedding community started dollar cost averaging into an ETF in mid-2022. It dropped another 10%, but now she's up 18% because she kept buying low. And that's the power of consistency. Another bear market strategy is to look for value. Bear markets mean clearance sales on companies. Great companies get oversold. Amazon lost over 40% in 2022, but was it broken? No, it was just discounted. And now for the bull market strategies. In the bull market, prices of stocks are already high, so people assume that prices of stocks will continue to rise, and therefore they tend to invest more by buying more assets. As a smart investor, you will watch out for events in the market, that is changes or decisions or policies of the government that can reduce confidence in the market. An example can be high unemployment numbers, or when the Fed announces high interest rates, stock prices will go down with such government decisions or announcements. And when such an event happens, you take advantage of the existing greed in the market and sell your stocks at a higher price before they begin to fall. Yes, exit before the next cycle begins. If you buy when prices are low and sell when prices are high, you are surely going to collect on earnings. When you buy in a bull market, invest in growth stocks. When the market is rising, growth stocks tend to shine. Think about tech stocks like Nvidia, Meta, or new IPOs. You ride the wave with growth stocks in a bull market, but don't get greedy. Here's an example. In 2020, someone I mentored invested $1,000 in Zoom when its value was around $120. They sold at $500 a few months later. That's how bull markets reward preparation. But you have to exit before the prices begin to fall, right? And I think Zoom is around $80 now from around $500 back then in 2020 during COVID. Now to the most important part, your mindset and risk control. Your emotions are the biggest threat to your portfolio. The market will go up and down. Your job is to stay consistent. And here's my pro tip to help you check your emotions and manage your risk. Use stop losses to limit your big losses. Don't invest money you need in the next 1 to 2 years. Stay focused on your long-term goals. And remember this quote: time in the market beats time in the market every single time. Now you know how to win in both bull and bear markets. The key is to stay informed, have a plan, and stick to it. If you enjoyed this video, give it a thumbs up and let me know in the comments what questions you may have about investing, and I will do my best to give you my insights. And share this video with a friend who is unsure about investing right now. Then download the WealthyGen app to start tracking and building your portfolio with confidence. It is one thing to start investing, but it is another thing to track and monitor your assets in one convenient place. The WealthyGen app is your path to clarity, confidence, and wealth. Remember, your path to richness is within reach. I hope this video helps you. Thanks for being here, and I will see you on the next one.